Hello everyone, I'm Thanuji Gunasekara, Dean Master of Financial Mathematics at University of Wollongong, Australia. Today, I'm going to discuss about the role of Black-Scholes model on a stock market crashes. What is Black-Scholes? The Black-Scholes formula, also called Black-Scholes model, was the first widely used model for option pricing. It's used to calculate the theoretical value of European-style options using current stock prices, expected dividends, the option strike price, expected interest rate, time to expiration, and expected volatility. The formula, developed by three economists, Fisher Black, Myron Scholes, and Robert Merton, is perhaps the world's most well-known option pricing model and was introduced in their 1973 paper, The Pricing of Option and Corporate Liabilities, published in the Journal of Political Economy. Black passed away 2 years before Scholes, and Merton were awarded the 1997 Nobel Prize in Economics for their work in finding a new method to determine the value of derivatives. The Black-Scholes model provides a fairly straightforward method for pricing and hedging derivatives based on various risk factors. The Black-Scholes mathematical model explains that the price of heavily traded assets follow a geometric Brownian motion that looks like a smile or smirk with constant drift and volatility. It is used to determine the fair price for theoretical value for a call or a put option based on 6 variables: the volatility, type of option, underlying stock price, time, strike price, and risk-free rate. The quantum of speculation is more in case of stock market derivatives, and hence proper pricing of option eliminates the opportunity for any arbitrage. There are two important models for option pricing, binomial model and Black-Scholes model. The model is used to determine the price of a European call option, which simply means that the option can only be exercised on the expiration date. Purposes of Black-Scholes. Black-Scholes pricing model is largely used by option traders who buy options that are priced under the formula calculated value, called as Black-Scholes value, and sell options that are priced higher than the Black-Scholes calculated value. It tries to evaluate the fair value of an option, and if it behaves well, then the option market price will equal the theoretical fair value. It helps to estimate the volatility of an underlying asset and to develop hedging strategies. The key idea behind the Black-Scholes models. The option price and the stock price depend on the same underlying source of uncertainty. The Brownian motion dynamics imply that if we slice the time thin enough, say dt, it behaves like a binomial tree. Reversely, if we cut delta small enough and add enough time steps, the binomial tree converges to the distribution behavior of the geometric Brownian motion. Under this thin slice of time interval, we can combine the option with the stock to form a risk-free portfolio. According to the hedging argument, choose delta such that F minus delta S is risk-free. Now we have a risk-free portfolio, so it must earn the risk-free rate. And mu doesn't matter for this portfolio, only sigma, the volatility matters. We do not need to worry about risk and risk premium if we can hedge away the risk completely. Here we go. Now I have the Black-Scholes formula. The C represents the call premium value, and S is the current stock price, K is the option striking price, E is the exponential factor, R is the risk-free interest rate, and T is the time to exercise. And ND1, ND2, this is the cumulative standard normal distribution from D1 and D2. And D1 is this, and D2 is the T1 minus S times square root of T. Here S is the standard deviation, or here we call it as volatility. We can replace this S by sigma. The model is essentially divided into two parts. The first part is SNG1, multiplies the price by the change in the call premium in relation to change in the underlying price. This part of the formula shows the expected benefit of purchasing the underlying outright. The second part, ND2K e to the power minus RT, provides the current value of paying the exercise price upon expiration. The value of the option is calculated by taking the difference between these two parts, as shown in the equation. The Black-Scholes model makes certain assumptions. The risk-free rate and volatility of the underlying are known and constant. No dividends are paid out during the life of the option. The efficient market, this means market movements cannot be predicted. The returns on the underlying are log-normal distributed. There is no transaction cost in buying the option. The option is European and can only be exercised at expiration, and the liquidity of the market. And while the original Black-Scholes model didn't consider the effects of dividends paid during the life of the option, the model is frequently adapted to account for dividends by determining the dividend date value of the underlying stock. Let's talk about limitation of the Black-Scholes model. Volatility. It's a measure of how much a stock can be expected to move in near term. It's a constant over time. While volatility can be relatively constant in a very short term, it is never constant in long term. Large price changes tend to be followed by large prices changes and vice versa, leading to a property called volatility clustering. And also, people cannot consistently predict the direction of the market or an individual stock. It assumes stock move in a manner referred to as a random walk. Random walk means that at any given moment in time, the price of the underlying stock can go up or down with the same probability. Returns of log-normal distributed underlying stock prices are normally distributed. This assumption is reasonable in the real world, though not fitting observed financial data accurately. Interest rates are constant and known, just same like with the volatility. It uses the risk-free rate to represent this constant and known rate. In the real world, there's no such thing as a risk-free rate. The underlying stock does not pay dividends during the option's life. In the real world, most companies pay dividends to their shareholders. The basic Black-Scholes model was later adjusted for dividends, so there's a workaround for this. Actually, this last assumption only related to the basic Black-Scholes formula. And no commission and transaction cost. The model assumes that there are no fees for buying and selling option and stock and no barriers to trading. Usually not true, as stockbroker charge rates based on spreads and other criteria. And also it assumes European style option which can only be exercised on the expiration date. American style option can be exercised at any time during the life of the option, making American option more valuable due to their greater flexibility. Markets are perfectly liquid and it is possible to purchase or sell any amount of stock option or their fraction at any given time. This again is not plausible as investors are limited by the amount of money they can invest, policies of their companies, and by the wish of sellers to sell. It may not be possible to sell fraction of option as well. Let's see. What is a stock market crash? A stock market crash is a rapid and often sudden drop in stock prices. A stock market crash can be the result of major catastrophic event, economic crisis, or the collapse of a long-term cumulative bubble. However, public panic is a major contributor. A stock market crash is when a stock index loses more than 10% in a day or two. The broad indexes are the Dow Jones Industrial Average and the S&P 500 and the Nasdaq. The rapidity of the decline differentiated from the stock market correction. That's a 10% loss over days, weeks, or even months. Effects of stock market crashes. Crashes can lead to a bear market, that stock market decline of 20% or more than last 18 months. When this happens, a stock market crash can cause a recession. What are the causes of stock market crashes? Economic policies that maintain the interest rate, hence increase the number of investors, leading more crashes. And traditionally, panicked sellers cause a crash, an economic event, catastrophe, or crisis triggers the panic. Possible causes for the decline included program trading, overvaluation, illiquidity, and market psychology are the causes of stock market crashes. So what are the examples of past stock market crashes? The stock market crash of 1929 kicked off the Great Depression. Over 4 days, share prices fell 25%. It began on October 24, 1929, known as Black Thursday. Stock price fell 11%, then recovered as 12.9 million shares of stock were sold, triple the usual amount. Trading on Friday seemed back to normal. However, the market dropped another 13% on Black Monday, despite the bankers' attempts to stop the panic. The next day, Black Tuesday, the market fell another 11%. The loss of confidence in Wall Street helped kick off the Great Depression. The Dow didn't regain its pre-crash level until November 23, 1954. This is how Wall Street crashed and the Dow Jones Industrial Average dropped in 1929 October. The stock market crashed in 1987. The Black Monday. The crash of 1987 occurred on October 19, 1987. The Dow index dropped 20.4%, the largest one-day percentage loss in stock market history. It took 2 years before the market returned to pre-crash level. The crash followed a 43% increase earlier that year. And the flash crash in 2010. The flash crash occurred on May 6, 2010, when the Dow plummeted nearly 1,000 points in just a few minutes, around 4 minutes. It was a technical malfunction caused by an unexplainable shutdown of quantitative trading programs. And dot-com bubble. The dot-com bubble crashed in March 2000. In 1999, stock prices of high-tech and computer companies were driven up. Investors who thought all tech companies were guaranteed money maker. Although there is no specific threshold for stock market crashes, they are usually identified as abrupt double-digit percentage drop in a stock index over the course of a few days. How to prevent a crash? Since the crashes of 1929 and 1987, measures have been put in place to prevent crashes due to panic stockholders selling their assets in a sale. One method is to implement trading curbs or circuit breakers, which prevent any trade activity whatsoever for a certain period of time, following a sharp decline in stock prices, in hopes of stabilizing the market and preventing it from falling further. For example, the United States has a set of thresholds in place to guard against crashes. If Dow Jones Stock Average Index falls 2,400 points before 1 p.m., the market will be frozen an hour. If it falls below 3,600 points, the market closes for the day. Other countries have similar measures in place. The problem with this method today is that if one stock exchange closes, shares can often still be bought or sold in other exchanges, in which case the preventive measures can backfire. Another way of stabilize the market is for large entities to purchase massive quantities of stocks, essentially setting an example for individual traders and curbing panic selling. However, these methods are not only unproven but may not be effective. In one famous example, the panic of 1907, a 50% drop in stock in New York set off a financial panic that threatened to bring down the financial system. The effect of Black-Scholes on stock market crashes. Due to the limitation and assumption used in Black-Scholes model, the theoretical values may be vary from the real values. The Black-Scholes value of the call option may be vary from the real call option value. As simplified volatilities affect the strike price, this may affect the reliability of the Black-Scholes model. Hedging strategies were blamed for the stock market crash of October 1987, but traditional models cannot explain how a relatively small amount of selling could cause so large a price drop. A drop in stock price caused the jump in growth rates and volatility after the crash, which has affected the market crash. Jump in prices also resulted the skewness in implied volatility. Suggestion. I suggest the Black-Scholes model should be improved by minimizing the limitation and reducing the gaps to be applied in more realistic option prices. As the implied volatility does not remain constant in real world, with the time, in real stock market, performance of the model can be enhanced by minimizing the volatility, smile, and option pricing defects. My conclusion. Black-Scholes model is the most significant formula in a financial market prediction. Improved Black-Scholes models have been introduced mostly after the crash on 1987. Several models such as jump diffusion, displaced diffusion, stochastic volatility model have been used to develop a more realistic Black-Scholes model during past decades. And this is my bibliography. You can have a look and get more information on the topic. Thank you so much and have a nice day.